There is a very good pool of assets with 10% yield and relative high quality. We do find these assets in various parts of the market, in bank subordinated debt, in corporates, in various sectors, and in a few emerging market sovereigns. Over the past few months, markets moved their focus from central banks and inflation to economic growth. We do think 2024 will see a continuation of this trend, and the main focus of the market will be on growth. In 2023, growth held up relatively strongly at global level, driven by the US, and we do think in 2024 we will see a change in this trend. US growth averaged 3% in 2023, and we saw a particularly strong finish with third quarter GDP data printing a 5% year-on-year. Next year, this trend will slow down. We have seen a slowdown in consumer good and retail sales, driven by an exhaustion of the savings accumulating during COVID. At the same time, labor markets in the US are turning looser. This is a very slow process, but it's very gradually happening. Just to give you a sense, non-farm payrolls in the US used to be 500K on average at the beginning of the year on a 3-month basis, and now they are 200K. So the US job market is creating less and less jobs, and the cornerstone of economic strength is very gradually being challenged. In our view, this will translate into slower growth in 2024 with an average 1% over the year. The same trend will be true around the world. Asia will slow down, driven by China. China held up around 5% this year, and it will grow between 4 and 4.5% in 2024, basically underperforming the government targets. And Europe is in a technical recession right now and will be growing at around 0% next year. Inflation is also continuing to fall. At monthly level, inflation is basically 0% across US and Europe, and all the big drivers of inflation are coming down at global level. Commodity prices continue to be stable or lower. Housing markets continue to come down. Industrial production prices continue to fall. So all the drivers of inflation are in check, and this is being reflected into the main prints. We do think that core inflation in the US will be below 3% by February, and in Europe it will be below 3% by April. In this environment, we think fixed income markets will be very well supported, definitely rates and quality assets, but potentially also credit. Given the very high level of real rates, we do not think a recession is necessary for central banks to cut rates, and in this environment, credit can do particularly well. Of course, we had 2 years of very high real rates and not a huge amount of consequences for the economy. If you think about refinancings for corporates or residential mortgages, they have been very low over the past couple of years because of the very long duration of the average loan. Over the next couple of years, maturities will go up and we may see a slight increase in default rates. So in this environment, you want to be careful and selective about what you own. The good news is there is a good part of the market which offers very attractive yields. When you take the global fixed income market, 15% of the market offers 8% yield or better, which means there is a very good pool of assets with 10% yield and relative high quality. We do find these assets in various parts of the market, in bank subordinated debt, in corporates, in various sectors, and in a few emerging market sovereigns. So overall, there is a good amount of high-quality assets with a good yield, and given our outlook for 2024, an environment with slow growth and lower interest rates, we do think this is the area where the risk-reward for investors is best. When it comes to emerging market ex-Asia, We do think cutting cycles will be particularly deep. In EM, growth is slowing, and at the same time, inflation is falling very rapidly. And emerging markets have hiked interest rates much faster and much higher than the US or Europe. In several emerging markets, including basically all of Latin America and a good part of Eastern Europe, hikes started 1 year earlier than in the US, and the overall amount of hikes was 3 to 4 times what was hiked in the US. So the amount of cuts we will see next year will be stronger and deeper than in developed markets, creating a very good opportunity on EM rates. Last, a market focus will be the one on fiscal policy. Remember, 2024 will be an election year. We will have European elections in summer. We may have a UK election, and we will definitely have a US presidential election in November. For this reason, fiscal and budget will be in check by the market. Fiscal policy has been under the radar in the past 5-6 months, and has been one of the key reasons why long end of global yield curves have been suffering so much. We do think the share of interest cost in government budgets is now excessive, and this is one reason that would basically lead to more fiscal prudence in 2024. But still, this will be one of the key focus of the market, and with the elections coming up, we may see more interest from the market on this theme.